that. You remember when we were growing up, of course, and we were on a long trip, and the kids in the back, Brian, would always say, "Are we there yet?" And trust me, you didn't want my dad to pull the Buick over. I assure you of that. But that is a question that we've been getting asked a lot.
It is, yeah. When I was the youngest of three, and so I always had to sit in the middle, and I'm sure I was the first one asking that question, so I should probably extend a heartfelt apology to my parents publicly here. But it is something investors have been asking about with rate cuts. Are we there yet? And I think we got a pretty good answer to that this past week. We know that over the last few weeks, we've gotten some data that suggested that inflation picked up again in January and February. Growth has stayed pretty good. Chair Powell came out during his press conference and effectively said that he's ready, willing, and able to start cutting rates, but not yet.
Yeah, and not yet. That is really the key, of course. And we've seen these inflation reports, January and February. He said that was an anomaly, and that may not really be what's going on. But our experience is we can see a resurgence in inflation. And so we look at dot plots. And I know we throw that term around, and I wanted to explain it because we had one of our listeners ask to explain the dot plots. And really, there are a number of Fed governors, 12 of them, the regional banks around the country, as well as the 7 that are in Washington, D.C. So there's 19 of these guys and gals who guess what they think rates are going to be like over the next 3 years. And that's what we're basing this on.
That's correct. And Governor Waller, so he's in Washington, D.C. on that board, where he came out with a speech and kind of explained the shifts in those dot plots and how he interpreted it. And really what we saw is that guess for where the federal funds rate will be by the end of 2024. So when they're making these guesses, it's always what is it as of the end of the year. So it never tells us sort of when, which month, which meeting are they expecting to cut. But the median, so if you look at those 19, right, so you have half of them above, half of them below, is still projecting 3 cuts for this year. But 2 of those dots kind of shifted up a little bit in the sense that maybe they think 2 might be more appropriate. Now, Governor Waller, he's in the camp of probably just one and done for 2024 and wait until 2025 to do some cuts. Earlier this week, we also had a speech from Raphael Bostic of the Atlanta Federal Reserve, and he said 1 should be good enough. So there are some who are saying, let's do 1. There are others who are saying we could probably squeeze in 4. So there is a big difference of opinion, and those dot plots really help paint that picture for what that difference of opinion is.
And that is really good. But of course, they are human beings as well, and they don't know what they don't know, and they are looking backwards. And what I mean by what they don't know, we're going to see an effect to the economy by what happened in Baltimore with the bridge. That is a port that exports a lot of goods, and that could have an effect on GDP, could have an effect on exports, and therefore the economy and inflation.
That's very true. And it gets to one of these things where it seems like every single quarter there's something that happens where if the Federal Reserve or if investors wanted to, they could look at the data and say, well, we will just dismiss that because there was, a port that shut down or there was some seasonal adjustment, there was bad weather or something. There's always a reason to ignore the data. But I do think we have to pay attention to that. With the port especially, that is the largest one for exporting and importing automobiles and light trucks for the United States, also for coal. You also have sugar going through there. Now, these are things, it's not like everyday purchases. I mean, except for maybe sugar, right? That these aren't everyday purchases.
I'm pretty good at that.
But it can still affect inflation and, as you point out, GDP as well. Automobile manufacturing, what is this going to do in terms of our ability to export vehicles through that? It's going to have a differential impact depending on the company. So a company like Volkswagen, their port was in a place where it might not be affected, whereas others like Chevrolet, other GM products, maybe Ford, they're more inland, and so they could be affected, and it will likely show up in the GDP numbers.
And that's the reason why we want to bring this up, because it affects real-world people. It affects people in Main Street every single day, and that's why we spend a lot of time talking about these things. So if interest rates go as expected, we're at about 5.5% and headed lower. So that means what should you do? For example, in your bond portfolio, getting 5% plus in money markets is probably not going to be there forever. There's some things that people can do I know that what we're doing here and our investment team, and that's probably the most relevant thing to talk about.
It really is. It's one of the biggest questions we get. In fact, one of the last questions that we got before the holiday was about, I have a certificate of deposit maturing. What should I do with this? What are my different options? And so what we did is we sat down and we looked at, consider this. For certificates of deposit, those are taxable at the federal and at the state level. Or do you buy a treasury security with the same maturity? Say it's a 3-year CD or a 3-year treasury bill. If it's a treasury bill, it's taxable at the federal, but not the state level. So really comparing those after-tax yields for that holding period led us to basically make the recommendation is that the treasury bill just makes a little bit more sense. But let's take a step back. And does it make sense to keep it in a treasury bill, right? Do you need that type of liquidity? Is it for cash management? Or is this part of your nest egg, something that you're hoping to grow over a longer period of time? In which case, why not consider allocating maybe even to equities, preferred stock, convertible bonds? There's a whole universe out there. Don't just narrowly focus on where can I get the highest yield on these short-term fixed income securities. Kind of take a picture or take the look at the whole picture for your financial situation.
And you look at, for example, the continuum. They could be, as you said, treasuries. They could be municipals. They could be investment grade, high yield, and so on and so forth. And that's the reason why we do a deep dive. Sometimes we spend a lot of time talking about equities, but fixed income should be part of this conversation right now. And it goes to getting a wealth metric. If you are new to us and if you want to experience that, it is a really good program to go in, and we do that as an offering to people who call us.